if you're incorporated and you overpay taxes, you have 3 years you can go back and amend your returns. So every 3 years have a different set of eyes on your taxes. In 2006, it was a crazy year because we had a company plane and 2 of my partners died in a plane crash. And I wasn't really myself during that time, and I didn't meet with my team, and I overpaid taxes by $54,000. But fortunately, I have the mechanism that every 3 years we look at it. So in 2008, I got the IRS to write me a check for a change, right? So you can go back and amend those returns. We've had people get $457,000 back, and we had one person get $951 back. I'm like, it's probably not worth it. He goes, if it costs me $950 to do it, I'm doing it. And so we gave him a nice discount and he got his money back, right? So reclassification of income is setting up the right corporation. Reclassification of income. So reclassifying income means we had this guy, Mike, who joined our program back in 2008. He lived in some place in Illinois I'd never heard of. There's no airport there. And he said he loved the program, but he wasn't going to meet with our accountants. And I was like, why not? He's like, well, because I have the best accountant in the world. I'm like, I'm certain that you don't have the best in the world. So certain that I'm a Bears fan, he's a Bears fan. I said that if we don't save you tax, I'll take you to a Bears game. If we do, you take me. And I should have been more specific because he took me to a Jacksonville Bears game, which is not top rap. I couldn't even see the field, you know? I was watching from my phone. And by the way, this is what we did. He was a sole proprietor. If you're a sole proprietor and you're a corporation and you have a company, 400% higher chance of audit by being a sole proprietor. A 100% chance of a higher tax rate because if you're incorporated and you overpay taxes, you have 3 years you can go back and amend your returns. So every 3 years have a different set of eyes on your taxes. In 2006, it was a crazy year because we had a company plane and 2 of my partners died in a plane crash. And I wasn't really myself during that time, and I didn't meet with my team, and I overpaid taxes by $54,000. But fortunately, I have the mechanism that every 3 years we look at it. So in 2008, I got the IRS to write me a check for a change, right? So you can go back and amend those returns. We've had people get $457,000 back, and we had one person get $951 back. I'm like, it's probably not worth it. He goes, if it costs me $950 to do it, I'm doing it. And so we gave him a nice discount and he got his money back, right? So reclassification of income is setting up the right corporation. If you're in a partnership, an LLC is brilliant. If you're not, it might not be the most effective thing because when you tax as a partnership, that's useful for you. When you don't, not as useful. If you're the only person in the business, an S Corp's great because you can differentiate your income by taking salary of what you would hire someone else to do your job and take everything else in distributions when you work on your business. And by the way, distributions, avoid the 15.3% self-employment tax. Even when that's capped out, you still save 3.2% on Medicare and Medicaid. Even when you get above $250,000, you save another 3.7% on the success tax that's added in there. So this is money in your pocket simply by taking your income differently. Anyone own a commercial building in the room? If you own a commercial building, you should be the meanest landlord in the world to yourself and charge the highest possible amount that you could justify because that comes in as a more passive-based income, which is taxed a lot less than income that's active, right? Or there's tons of ways you can move ordinary income into capital gains income, and I shared that with another thing. Now, maybe in your businesses, you even create like businesses that branch off from your business, or like we have a lot of people that are in the health space and they do supplements. We have them set up their supplement business when it's starting in a C corporation because your first $50,000 in a C corporation is taxed lower than individually, an LLC, or an S corp. It's taxed higher after that, but it's less at the $50,000 and below, so we can set that up as an incubator company and then move it back into the major organization when it gets above $50,000. And our average savings on tax for every $250,000 someone makes is $11,430. By the way, that's bottom line spendable cash. That doesn't require revenue that you pay employees and all that kind of stuff. And I've even talked about if you own a building, you should cost segregate. I mean, I could talk about tax for hours and hours and hours, and then you guys would get eventually really, really bored of me and tired of that. Financial capital is a byproduct. In the world of cause and effect, value creation is at the cause and dollars are the effect. So financial capital is like the receipt at the grocery store. It's evidence. It's not the actual meat and potatoes. The meat and potatoes comes in 2 forms. The first one is mental capital. Mental capital is knowledge, ideas, concepts, systems, tools. Have you ever heard the notion it's not what you know, it's who you know? Not in today's world, because if you don't know anything, no one wants to hang out with you. You know, it's like, oh, here's little Johnny, he brings nothing to the table. Let's invite him to the event. No, what you know, we're not in the time of brawn anymore. We're in the time of brains. There's kids that my kids watch on YouTube that are multimillionaires because of the advent of the internet and of technology, you know? Yes, in the past it might be which family you were born into, and if you're part of the Lucky Sperm Club, then great, you're fine, you know? But now, there's so much more opportunity for everyone. It comes down to mental capital. What you know matters. And in the financial world, part of the reason I was able to go to Italy, part of the reason I'm now entrusted with kind of this family legacy for my family, isn't just because of not just because of I made the leap and did the business. That's why my grandfather was so worried, but because I actually went out and did what the Rockefellers did. The Rockefellers, they built a financial team. They're now 6 generations strong. 6 generations. They donated $50 million to charity so far this year, and they're on their 6th generation. The Vanderbilt family, though, had more money than the U.S. Treasury and destroyed it within 54 years of Cornelius's death. They didn't have the right mental capital. How was the money made? I don't want to screw my kids up into being entitled brats. I want to make sure that they can really appreciate where we've come from and what's possible, and it comes down to 3 families. One is the family office. If you know in your business how important a good team is. What about in your financial life? I see too much leaking and lost money because fractions of their team are missing, not communicating, or completely not coordinated. That is a huge part. The second family is family retreats. Treat your family like a business from a standpoint of you have meetings in your business, you research stuff in your business, you have symbols for your business like logos, you have taglines. What about having that for your family so you pass on traditions and rituals and also your philosophies, not just your money? Money with no philosophy is a surefire way to destruction. Right? And the third family is a family constitution. When the U.S. built the Constitution and we used to use it, it was super effective. So I actually have 52 pages of the most important book I wrote was my family constitution, which is our signpost for the next generation. So that's all mental capital. Because I want to make sure you have sustainable wealth, not a flash in the pan, not one client reliant, not if the economy's good. When you're economically independent, you have staying power. You're in a great place. So the second thing that creates financial capital, the first one is mental capital. The second is relationship capital. People, networks, Angelique, organizations, you know, mentors, like customers, people with a lot of information that never translate that through serving, through solving problems, and through delivering value, remain broke. They're smart people without a lot of money because it doesn't transfer and bless other people's lives. So relationship capital is key, and here's what I know. Where most of your wealth sits right now stagnant and it's never been tapped into is your relationship capital. Because people that attend things and invest in themselves typically are amazing contributors, but they totally suck at receiving. Like when someone says, what can I do for you? I'm good. That's good. Life's good. When someone asks me, I got 3 to 5 things I'm going to talk about because it's not just if they can help me, who do they know that can help me, right? So I'm actually going to test this equation out on you because I don't know what the mental capital is worth to you at this point. You don't even know because I've only spent about an hour with you. But I know that with me in your life, as your advocate for your finances, that relationship capital that I bring with the best attorneys, the best accountants, the best investment advisors, the best cash flow specialists, you might have parts of your team totally dialed in. We're going to say, awesome, keep them. But the pieces that are missing, I want to fill in that gap.
Want to master your money? Want to figure out the things that you could do to improve your finances? Click here and check out more videos like this on Money Matters.